Hello, everyone, and welcome to the Veterinary Business Podcast, your place for inspiration, guidance, and real stories from veterinary medicine. I'm Adisha, one of your co-hosts. Before we dive in, I want to take a moment to thank the true hearts of veterinary medicine. You, our listeners, the veterinarians, managers, and professionals who dedicated yourselves every day to the caring of animals and your communities. Your passion and commitment inspire everything we do here. To show our appreciation, we are offering a complimentary veterinary practice marketing strategy session exclusively for our listeners. This isn't a generic consultation, it's a personalized, actionable session designed to help you identify growth opportunities, attract more clients, and strengthen your practice presence in your community. To claim your session, simply visit Veterinary Business Institute, that's one word, veterinarybusinessinstitute.com/MSM. You'll also find the link in the show notes of this episode. It's our way of saying thank you for all the long hours, dedication, and love you pour into your work every day. And we hope this session helps your practice thrive because your success is what inspires us to keep bringing you these episodes. With that being said, today's episode dives into a topic that many veterinary practice owners quietly struggle with: navigating taxes, maximizing deductions, and understanding the changes in the most recent tax bill, all while keeping your practice financially healthy and growing. To help us unpack this, we are honored to welcome Holly Corcoran to the show. Holly is a forward-thinking CPA and a business strategist with over 3 decades of experience helping small to mid-sized businesses, especially veterinary practices, thrive. As the founder and CEO of Corcoran Business Advisory Services, Holly works closely with the veterinary practice owners to scale their business, optimize resources, and build sustainable success. She goes beyond traditional accounting, acting as a true non-equity partner to guide business owners through complex decisions involving mergers, acquisitions, cash flow, profitability, and tax strategy. Hello, Holly. Welcome to the show.
Hello. Thank you so much for having me. I greatly appreciate it. Glad to be here.
Fantastic. So, before we dive into the details, can you share a little bit about yourself and your passion for helping veterinary practice owners thrive, in your own words?
Oh, sure. I really appreciate your introduction. It really gave a good business overview. I personally have an affinity towards veterinarians. My daughter is an equine practicing veterinarian in Pennsylvania. I have very many friends that are veterinarians, and I ride in an endurance sport with horses that is governed by veterinarians. So it just seemed like a really perfect fit. I understand much of the language, but I'm also not too shy to ask questions. So I love working with vets. You're passionate about the work that you do, and I know the areas that you need help taking those burdens off your plate.
Okay, wonderful. And yeah, I can see in your own profile picture itself your passion for horse riding.
Yeah.
Now, yeah. So thank you, Holly, for sharing your passion. And well, let's dive in, right?
Okay.
Taxes can often feel confusing and overwhelming for veterinary practice owners, especially when new legislation comes into play. Changes in tax laws can impact not just your personal finances, but also how you manage and grow your practice. With that in mind, Holly, can you give us an overview of the HR 1 bill that was passed this past July? Was it strictly a tax bill, or did it include other provisions that practice owners should be aware of?
Yeah, it was a sweeping change on many levels. We'll talk about some of the tax aspects a little bit more in depth, but what happened was there were sweeping changes to many programs. There's cuts in Medicare that are going to take place in 2028. The Care Act is currently experiencing changes because the credits that were available through income tax funding is not going to be available any longer. And so health insurance premiums are expected to rise dramatically. Veterinary practice owners need to be prepared for this health insurance increase because it's not just going to affect those people going to the marketplace, but it's also going to affect you on your business premiums. So you want to make sure that you review your benefits package and be prepared for the increases so that you have good cash flow. Or you might want to look at placing caps on what you are able to provide to your employees and maybe implement something like a cafeteria plan that would allow those employees to receive tax benefit if they have to contribute as well. And that's just a minute aspect of some of the other changes that happened within the tax law for HR 1 bill. The big ones is the taxes, obviously.
Right. Yes. Can you get into it a little bit?
Oh, absolutely. So let's see here. Let's start with some of the things you're just going to keep in mind practically, because we have to report at the end of the year on W-2s and 1099s for either our employees or our independent contractors, their income for the year. So this is something that I would suggest you reach out to whoever does those forms for you. It might be your payroll provider and so forth to make sure that information is being tracked. And two of the items that affect W-2s that were in the HR 1 bill are tips and overtime. Tips are not going to affect veterinary practices, but overtime definitely will for your non-exempt employees. And you want to make sure that the overtime has been correctly traced during the year, because it goes all the way back to the 1st of January. So you want to check with your payroll provider, or if you're doing it in-house, to make sure that that is properly identified. And just to keep in mind that it's not going to be the entire overtime amount that is deductible, but it's going to be the 50% over the standard rate. And then for 1099s, like your relief vets and your any unincorporated business that you're paying more than $600 a year needs to receive a 1099 for service type payments. So in other words, that could be your relief vets, it could be your lawn guy, it could be janitorial or cleaning service, it could be a handyman that you have that comes in and that is not incorporated. So keep that in mind. And then in 2026, that limit is going to go up to $2,000. And then there's a couple of other tax aspects that relate strictly to vet practices, if you want me to go forward.
Yes, please. Yes, please.
Okay. So what happened was in 2017, there was a new Tax Cuts and Jobs Act that was put into place, and it specifically had sunset provisions, which means that the rules were going to then go back to the old rules as of the end of this year. And what the tax bill in July did was make some of those changes permanent. It also expanded some of those provisions, and it provides some additional deductions for small to medium-sized businesses, some for very large businesses. And what I'd like to talk about just really is some of the key point items that vet practices will want to keep in mind for their year-end taxes. And one of those things is buying equipment. And I know you've been in this situation before. If you've been in practice for a while, you can buy equipment and it can be subject to depreciation, or you might get 100% deduction. And one of the new things is the bonus deduction, which allows now up to 100%, which used to be 20%. And I know most people hate us talking about code sections, but code section 179 depreciation is 100%, and that's also available. But you want to weigh these two programs to see which is best for the practice. Some of the other items are on-site daycare costs. These provide credits that are up to 50% of the cost and maximize up to $600,000. So if you can go in with other vet practices and make a co-joined veterinary, daycare program, and the costs and expenses that you pay towards that are fully deductible, which is great, and also can provide credits. So some of the other areas are if the practice files up as a partnership or as an S corporation, which are considered flow-through entities, one of the things that was made permanent for 2025 going forward is the qualified business income tax deduction. And it's basically very simply 20% of your net income coming to your personal 1040 from the practice. Consider and keep in mind that veterinary practices are considered what's called SSTBs, which are specified service trade or businesses, and they have limitations on that deduction on your personal return. So if it turns out that you and your vet partners are looking at not receiving that deduction on a consistent basis, you may want to talk to your tax professional and say, hey, it might make sense to look at an entity selection or change. So just to keep that in mind, and that it's going to provide additional deductions on your return. One of the things that's many practices take advantage of is providing meals for their employees. And that used to be 100% deductible. It's now 50% deductible. And unless you are taking the employees out to a social event like a Christmas party at the end of the year, you can take 100% of that deduction still. So, when I say these dollar amounts or these percentages and so forth, one of the things you really want to keep in mind is that your bookkeeper or whoever, or your practice manager or whoever is tracking your expenses, putting your income and expenses into your general ledger is well educated. Because if they are in a position where they can flag these type of things on your behalf, then your tax preparer, your CPA at the end of the year can make better choices for you. So I don't want you to have to remember these different dollar amounts and percentages because that's not your job. That's the CPA's job. Another area is paid family leave. That provides credits against the wages paid. So if this is something in your benefits package, keep that in mind because there are advantages for tax purposes. You have increased dependent and assistance programs coming up in 2026. It used to be that you could provide $5,000 tax-free for your employees for dependent care reimbursement, and it becomes non-taxable. It does get reported on the W-2, but it's only at the end of the year when they file their tax return that they have to reconcile against the actual costs that they expended for their child care costs. Does that come into play? So it's still non-taxable. In 2026, it's going to go up to $7,500. So it's something that you might want to look at your benefits package for 2026 and increase the amount if that makes sense for your practice. Another big thing that I really like for veterinary practices is employee reimbursement for education costs. And this is something that has actually been around for a long time, and it's up to $5,250 per employee tax-free. But the new provisions over the last couple of years allows the employer to reimburse the employee's student loans. And that can become very important when you're talking about your associate vets or young vets coming into the practice that have high student debt. This is a great way to provide that type of benefit. And between that and the dependent care benefits that you may have in your employee handbook, just keep in mind that depending upon the size of your staff, if you choose 2, 3, 4, 5, or whatever the dollar amount is, multiply that by your eligible staff to make sure that for cash flow purposes, if everybody takes advantage of it, you need to be able to provide it. But also, these are benefits that can help the owners, so you're not restricted from these benefits. So those are some of the major things for the new tax laws that I think really need to be kept in mind by veterinary practices. But there are a lot of other provisions and can be very specific to their practices, and it's important to be working with their CPA or tax strategist.
Holly, you touched on a very interesting part because recently when we were doing an expert panel on the Veterinary Business Institute, there was an question by students to get the reimbursement for their debts.
Okay. Yeah, it has to be a plan within the veterinary practice. So it should be in the employee handbook that the owner has designated they are willing to do these education reimbursements. That's where it starts. And then what happens is the employee can provide documentation of their education expenses that they've paid out of pocket to their employer, and then their employer then will reimburse those costs. So it could be that, their monthly student loan cost is $1,000 per month, and that's going to be eaten up pretty quickly. But that's pretty much how the program takes place, is going through the employer.
Okay. Thank you very much for that, Holly. I mean, there was a lot of absolutely fantastic tidbits with regards to what practice owners can look at or consider when they're thinking about the new tax laws. And just another thing. So what are some of the changes that affect the veterinary practice for an year-end reporting for payroll and independent contractors like relief vets?
Yeah, as I stated at the beginning when we talked about it, the W-2s are going to need to track the overtime. And for the 1099s, they'll need to make sure that they're paying anyone over $600 for service type business, service type payments that are unincorporated businesses. They have to file 1099s. And another good tidbit is before even making these payments, whoever it is that actually distributes the cash to the payee, such as the bookkeeper or the practice manager, make sure they have a W-9 on file, because that provides the information necessary to be able to issue that 1099 at the end of the year. And then you're not facing, trying to scramble at year end to get those forms done.
The next question we have for you, Holly, is what tax planning options vet practices owners may take with the new and old tax laws that are good to know before year end? I mean,
absolutely. Yeah, I mean, the new tax laws provisions provide some additional benefits, but some of the, practices that are available for your business that have been established over time still are very important. And I think in veterinary practices, your retirement planning is going to be paramount. Many practice owners assume that when you retire or when you're ready to sell your practice, it's going to provide you that big nut to be able to afford your retirement. And some rural practices or solo practitioners are finding that their practices may not command the value that they thought they were going to. So it's really important that you concentrate on saving incrementally and saving taxes at the same time. That's through your retirement plans. And two of them that I really suggest are the Simple Plan or the 401k plan. And as the Simple sounds, it is easy to set up and establish. It has to be done before October 1st of any tax filing year. But once you put it in place, you have contributions that you can make on behalf of your employees. The employees have the ability to put away money on their own behalf and receive tax deductions. And for 2025, it's up to $16,500 per employee. And then if you're over 50, you have a $3,500 catch up. So that's around $19,000. So the 401k is a little bit more complex, but boy, the dollars you can put away are tremendous. It's a little bit more expensive to set up, but there are tax credits available to offset that cost. So you actually almost get it back through your taxes. And the other thing is you'll need a plan administrator because there's certain year-end filing requirements that are necessary for a 401k. But you can put a lot more away. The employee can sock more away, which means you, the vet practice owner, and it can be in excess of $50,000 a year benefit. So that's huge. And the other thing, too, that's available through most 401ks, or if you're establishing one, please keep this in mind, that if there is a profit sharing component, It's a decision that can be made after year end, whether you fund it or not. And that can give you a little bit of flexibility to say, you know what, I don't have the money in December or whatever the choice may be. I have up until I file my return either March 15th or with extension up to September 15th, and fund that extra profit sharing. Now, keep in mind, it goes to employees as well as the employer, but it is an additional expenditure that you can make that provides a deduction and puts more money in your pockets. Another area is health insurance. And the premiums that are paid directly to on health insurance premiums for a group plan that's held through the practice are fully deductible and non-taxable to the beneficiaries, to the employees, to the owner. So what happens, though, is if you reimburse your employees for their health insurance that they may get through the marketplace or elsewhere, those are considered taxable compensation. So you might want to consider putting in a group plan when it makes sense, because it can change your numbers for workman's comp, your insurance premiums, your other benefits that are subject to the wages. So keep that in mind, that health insurance premiums are deductible and are not subject to tax if they're paid through a group plan. But also, another area that you might want to keep in mind is your real estate. How are you holding your real estate? Is it held by a related party, or do the practice owners hold the property? Have you looked at it recently? Have you looked at your lease that you have with the real estate to the vet practice? Is it something that's called triple net, which allows the practice to pay the highest percentage operating costs, as well as the rent that they would be paying to the entity that offsets the mortgage? So that's something to really look at. The other thing too is, are you leasing your vet office? Are you looking at selling in the near future? Because leases in specific areas are not necessarily transferable. So I know that's not necessarily a tax tip, but it's something to keep in mind and to look at when you're renewing your lease with your landlord. Vehicles are another aspect. It's not necessarily this one for a small practice owner, which it doesn't have a lot of running around to do, but a ambulatory equine practice, mobile vet, large animal that's, they're out in their trucks going place to place. Those vehicles are 100% deductible, and all of the operating costs, the interest paid on any loans if you have them, the repairs and maintenance, the insurance and so forth are all fully deductible and can provide deductions for the tax practice. So those are just a few items that are, kind of oldies but goodies, but really definitely something to keep in mind before year end.
Okay. You spoke a lot about what can be deductible. Can you give a few insights as to what practice owners may think is deductible but isn't?
Oh, that's a really good question. Like we talked about with the meals, there are going to be certain limitations, but also officers' life insurance. So if you have life insurance that's paid through your practice, that does not become a deduction. But conversely, those premiums, if they come back into the practice, are not considered income to the practice. And that can be a good business planning tool for, transition of the practice should something bad happen. Disability insurance. You may pay disability insurance for your practice owners. And again, that's something that's not necessarily deductible incrementally, but if it's actually paid to the practice, or if it's even paid to the individual, those are not considered taxable income. So it's kind of mirrored in that regard.
Okay. And you spoke very briefly on perhaps, if you're planning to sell, right? So even if an owner isn't planning to sell for another 5 to 10 years, what financial, or rather tax strategies particularly, should they be implementing right now to maximize their practice's valuation for an eventual and profitable exit?
It's a really good question, because there's something called book versus tax. And, if a broker comes in and they're looking at the book value of the assets that are there, equipment and things like that are not necessarily worth a whole lot of money unless they're up to date. And that may be a good reason to make some improvements now, especially if you're further away from retirement, so that you are in a situation where your practice is, technologically up to date.
Okay.
And that way you get the deductions now. And then later on, when they go to look at the practice, a buyer coming in, the value may not necessarily dollar for dollar go to that equipment, but the fact that it's up to date is going to be very important to that buyer because they know they can come in, they can potentially practice the type of medicine that they're interested in practicing. And, they're not worried about having to do a whole lot of updates up front. And it can be the same for your building too. If it looks, kind of shabby, you might want to start doing some improvements now, and that may be done either through that separate entity or yours. You can do it as leasehold improvements. And these are all things that kind of help stage the practice so that it's ready for resale that can have tax advantages as you're doing it and then help build that value when you go to sell.
Okay. Just on that topic, for owners who own the building their practice operates in, right? What is the biggest strategic mistake they make when structuring the relationship between the practice and the real estate, the holding company? So how can they optimize this to build, personal wealth and save on taxes simultaneously?
Okay, that's a really good question. First of all, the biggest mistake I've seen is that the practices, especially those that may have been in place, 20 years ago or whatever, they may have put the building right into the practice and depreciating it right along with the practice. And that's really not a good choice because it could be subject to double taxation when it's sold. It could be subject to built-in gains if you decide to change from one type of an entity to another. But assuming that you made a good decision up front, worked with your attorney, set up a separate entity, and got that building, placed in that separate LLC is a good choice because it helps, and an attorney will tell you this probably more than I, but it'll help with the liability protection on that building. And for tax purposes, we can set up that lease, which is going to be integral. And that's another mistake that I see, happening, that they set up the separate entity and the attorney may have suggested a lease. They may not have formalized it. You need to have that lease in place that really defines who is paying what. Because under audit, the IRS agent will come in and want to see that lease and make sure that it's an arm's length transaction. And then the third thing that I think is really important is that it's triple net, which I alluded to before. And what that means is that the practice pays as much of the operating expenses as possible, which can be the real estate taxes, the common area maintenance, the insurance, everything almost except for the rent that's going to cover the mortgage that goes to that separate entity. That way, you're receiving taxes on what's considered earned income and at a higher tax rate. And then the passive entity is passing on perhaps a net income. A lot of times it's break even, and that is taxed at a lower rate, specifically, especially if you're in a partnership where you're looking at self-employment taxes. And then a fourth item might be when you're looking towards that sale, and you want to say, am I selling just the practice, or am I going to sell the building with the practice, or am I going to provide an option to buy that building down the line from, for the buyer that is now buying your practice? And that may be a good tax strategy as well, is to say, you know what, you're welcome to pay me rent for the first 3 years, and then you have the right of first refusal or whatever it may be that you can buy that real estate. Because what that helps do is change the timing of the capital gains that you'd be, recognizing on the practice. You can defer the building side of it until another couple of years. You may also have greater appreciation over those couple of years, and therefore you're saving tax dollars and hopefully putting them into a lower bucket since you're not putting it all into one tax year.
Wow. Holly, really, when you put it like that, it seems like almost reading something very simple, right? But really, it's not. It's really much complicated, and it's thanks to your experience over the years that you have been able to synthesize that information so well that anyone can understand it easily, right? Now, what advice would you give to veterinarians who feel overwhelmed by taxes and how to manage them in their practice?
Oh, absolutely. I think that's a great question because that's what I see. I can be talking to you like this and I know the numbers. It's just like you know the medicine. And if you're telling me the diagnosis of my pet and I'm stressed, my eyes may glaze over. And I think a lot of times veterinarians are the same way, that there's just so much involved in a whole nother complex, financial issue that they really worry about. But how do they, get out of that feeling of feeling overwhelmed is really working with, the right people. And if you have your internal bookkeeper, make sure that you invest in training for that internal bookkeeper, or they work very well with your external CPA, tax preparer, so that they know where to put certain financial expenditures and or income, so that they know when they go to file the tax return where to look, where to make sure that they're receiving the best tax benefit. And that might be your bookkeeper, it might be your practice manager, or you might choose to use an external veterinary bookkeeper who is used to doing this type of work on behalf of veterinarians, because you can take advantage of so much more before year end that you can after. And as I said, with, say the 401k profit sharing, you do have some decisions that can be made after the year, but don't treat it like it's just a compliance issue, because this is very expensive. And this is where you can really save real dollars. And the other thing I'd say is implement plans incrementally and take determined, measured steps. So yeah, maybe I want to put a retirement plan into place, but I don't have really the resources yet to sock away enough in a 401k. Start with the simple. Or, do I have an employee handbook in place that defines all of these wonderful benefits that I can gain tax advantage for? Maybe you need to delegate that to an external HR professional or someone like that that can really get those pieces in place. Deal in the areas that you have the best expertise, delegate to those within your practice that are able to help support you, delegate externally to those that have the expertise to help you there. So I think that would take a lot of the stress off of most of our vets that are worrying about taxes and wondering if they're paying too much.
Absolutely. And Holly, if the same vets are interested in getting in touch with you, how can
the best place really is through my website, which is CBAS, which is for Corcoran Business Advisory Services, -CPA for Certified Public Accountant, .com. So CBAS-CPA.com. I do have my telephone number on the website. I do have a scheduling link. I have great blogs, that you can read. And I'm also available on Facebook and Instagram and LinkedIn. So anywhere you would like to make contact with me, I'd love to have a conversation. I do provide either a very quick 15-minute call to see if it's a good situation to work together. And then if that makes sense, we can set up a discovery meeting, which usually takes about an hour. And that's also complimentary, where we have the opportunity to really dive deep into your practice, see if you need business advisory, if you need tax, if you need both, and then plan accordingly from there where our services will progress.
Okay, wonderful. And with that, we have arrived at the end of our podcast here for this evening. So thank you so much, Holly, for joining us today. And I want to take a sincere moment to thank you, our listeners. Truly, this podcast wouldn't even exist without your support, your time, and your passion for veterinary medicine. Every episode we create is for you, to inspire, to guide, and to share stories of the matter. So, if today's episode resonated with you, which I'm sure did, we'd be so grateful if you share it with your colleagues, friends, or anyone who could benefit from it. And if you could take a moment to leave a review on your favorite podcast platform, it would mean the world to us. Your words help other veterinary professionals and practice owners find this podcast, and together we can continue to grow this community of care, learning, and connection. So until we meet again, keep leading with compassion and make life better for your patients and pet parents. Enjoy the rest of your week.